Dow up more than 800 points as we head into the close. Let's get three-stock lunch under our belts and a look ahead to the busiest week of earnings season. More than 30% of the S&P 500 set to report. And among the biggest names, AMD after the bell Tuesday, Marriott before the bell Thursday, and DraftKings before the bell on Friday. Here to help us trade them all is Scott Nations. He's president and CIO of Nation Shares. Scott, good to talk to you. And let's kick things off with AMD. Would you buy it?
Well, this one's really interesting, so this is a good one to kick off with. They pre-announced results on October 6th, and it was an unmitigated disaster. They guided everything lower, margins, EPS, and revenue, and the stock took a 13.8% hit, almost 14% hit because of that. But since then, it's been sideways, which is good because it's still down 57% year to date. The most interesting thing about AMD, though, is going to be this earnings announcement on Tuesday. Why? It's because we'll call it consensus EPS is for a profit of 68 cents a share, but they're all over the road. The low estimate is 53 cents. The high estimate is more than double that at $1.07. And so what's really going to matter here is the commentary. Investors are going to want to hear from leadership about what they're going to do as far as scaling back production or canceling CapEx that is cancelable. If there's any upside here, it's that Meta is going to continue to spend a ton of money, and that's the only thing that's going to help AMD right now.
All right, let's move on to Marriott. Scott, check in, check out.
I buy it. I like Marriott. Big rebound in travel, and it's not just a big rebound in volume. It's the fact that they have tremendous pricing power. That's reflected in the fact that the stock is down less than 5% year to date. The issue for Marriott, though, is going to be debt. They have $1.5 billion due in the next 14 months. That's actually about what they raised during the pandemic. But the company's focused on debt. They say they want to reduce it. If they can manage to do that, it would be very, very impressive. With a forward PE of nearly 22, it's not cheap. And with a beta of 1.57, it's generally the broad market on steroids. But again, if they can cut debt, good for them.
How would they cut it? Would they pay it off or would they roll it?
No, they want to pay off what is due over the next 14 months, and then they want to buy back some longer-term debt that's due after that.
Mm-hmm.
All right, our final name, and just as the World Series is kicking off, DraftKings. Would you bet on it?
No, in fact, I would bet against it. I think DraftKings is like being in a car crash while you're on your way to a train wreck. The company is expected to lose $2.50 a share this year. The competition in the space is just incredible. It's insane. Unless there are some failures or some consolidation, I think this entire space is just going to be lost money. And why? Well, a big part of that is the customer acquisition costs, which are outrageous. So estimates of anywhere between $700 and $1,000 per customer for acquisition costs for all these online sports books. This is just a place to stay away from until there's a little consolidation.
All right, Scott Nations, thanks for bringing us your picks. Have a great weekend.